October proved to be a pivotal month for gold in the global precious metals market, seeing gold rise 6.8% and culminating in a historic monthly close of $19.97 an ounce. Now, this is the highest ever finish for the LBMA precious metals price, and the increase reversed an initial downturn in the month, and the resurgence was primarily attributed to safe haven demand fueled by escalating geopolitical tension. Now, October started with the gold prices trailing below $18.50 an ounce at the end of September, but with the tragic geopolitical events of October 7th in Israel, a rally was sparked that catapulted gold prices above $2,000 an ounce. Notably, this record high closure resonated across major currencies, reflecting in a global shift in prices. Now, globally, gold bars and coins had a strong first half of the year. Investments slowed slightly in the third quarter, but quarter-over-quarter demand was still above the 5-year average. China's appetite for gold was the strongest since 2021, and a depreciating currency and lack of alternative safe haven assets sent people scrambling to buy gold. The People's Bank of China continued buying as well, with demand in China boosting 16% year over year and 66% quarter over quarter. India and Turkey also posted remarkably higher demand, and overall, central bank buying was back in force, positioning to acquire more gold in 2023 than even last year's record-breaking level of purchasing. Now, central bank gold buying has helped prices defy the headwinds of surging bond prices and a strong US dollar. In order to sustain this bullish momentum, analysts believe that geopolitical risks must continue to worsen, bond yields in the dollar must peak, or there would be a bearish trend in equities coupled by a resurgence of recessionary fears. When looking at each of these key factors, we see it as very likely that gold will be seeing significant growth in the near future. With geopolitical risks, the Russia-Ukraine war is elevating tensions, disrupting supply chains, and dampening economic optimism with rising energy costs. All of this slows the economic growth and adds to an increase in inflation, moving the global economy closer to stagflation. The recent spike in bond yields has been wreaking havoc on the economy, and we may see a tug-of-war between stocks and bonds in the near future. And additionally, stocks have been in a continued downward trend. After a solid start to the year, stocks have been suffering declines in August, September, and October, giving back nearly half of their early year gains. 6 out of the 10 industry sectors in the S&P 500 were in negative territory throughout the first 9 months of the year, and the Nasdaq is down more than 10% from its mid-year peak during what should be seasonally the strongest period. Now, a greater than 20% drop would effectively enter into a bear market and could spur additional interest into gold from investors as they realize that buying the dips in stocks may no longer pay off. In the past 2 years, we've cemented gold's ability to remain strong in turbulent environments as demand for gold continues to climb. Gold is set to break out further as current conditions worsen, and now is an opportune time for investors to safeguard and hedge their portfolios against coming volatility. If you're concerned about protecting your investments and getting some risk off the table, I'm Makai Block with American Hartford Gold. Give us a call today, and we'll discuss how adding physical precious metals to your portfolios can give you the hedge that you need.
Discover how gold can help you protect yourself and your family. Call today or visit our website for more information at AmericanHartfordGold.com.